Well, the bad news is that stocks look pretty expensive. The good news is there's a big divide between the valuation haves and have-nots. There are plenty of cheap stocks out there, and here to talk about a handful with me is Andrew Wellington, co-founder of Lyrical Asset Management in New York. Hi, Andrew. What does it mean for investors when you have a disparity this wide? You said it's only been this wide once before in terms of the expensive stocks versus the cheap ones. What will we expect to happen from here with the cheap stocks?
As you're saying, we see the market kind of split between haves and have-nots in terms of valuation. And half the market is really expensive. The overall market looks a bit expensive, but half is really expensive. And those stocks are the yield stocks, the stocks that people are perceiving to be super safe, like consumer staples, and then the stocks that people think are going to grow forever, like Facebook and Amazon, Netflix and Google. And they're bringing up the overall valuation of the market and making the overall market look expensive, and they're very expensive. But what they're masking is about half the market is really cheap, and it's full of basically everything else.
Time for the picks. Whirlpool is the first one. What do we like about Whirlpool?
Yeah, we pride ourselves at Lyrical of making exciting returns from boring stocks. And I would say a manufacturer of washing machines and dryers and ovens and ranges isn't the sexiest business. But Whirlpool is attractively valued, and that's what valuation is ultimately what drives returns. Paying a fair price for a good business doesn't give you a good return. You have to pay an unfair price, a really cheap price. So Whirlpool today is about 10 times earnings. I think the market isn't giving it credit for understanding that although their earnings have rebounded and are reaching new highs since the fall off from the housing bubble, the business today the industry has not fully recovered from that. And so appliance sales today are still below trend, which means the company should grow at an above average rate for the next several years. The other thing is Whirlpool, the name's the same for a long period of time, but the company itself has dramatically improved over the last 5 to 10 years. They merged with Maytag, they took a ton of cost out. The business is making more money overseas than it ever has, and it's a much, much better business today. And again, we don't think it's getting the full credit for that.
Okay, Lincoln National, this is an insurance business. Did I hear you say earlier that it's trading at 6 times earnings?
Yeah.
Pretty cheap.
10 is really cheap. 6 is crazy. Now, Lincoln National, perhaps even what's more boring than appliances? Life insurance.
Don't tell that to the insurance people.
But it's okay, because valuation is what makes it exciting. Paying 6 times earnings, while it is a more moderately growing business, it's not that exciting that way, but at 6 times earnings, it's worth substantially more today, probably more than double that. It used to be at least a 12 PE stock in the not so distant past. And I think this industry, or at least Lincoln by itself, gets wrongly criticized for its sensitivity to interest rates. There's this common view that low interest rates are bad for life insurance companies because they own lots of bonds, and so they're not getting a lot of interest income on those bonds. Well, that's okay, because they know they're not getting a lot of interest income on those bonds, and so they charge higher premiums. There's a lot of levers management has to pull to manage this business through different environments, and as a result, even though we've been in this low interest rate environment, and maybe they're going up or maybe they're staying low, but if you look at the bottom line, Lincoln National has seen its profits grow in a very nice, steady, stable pattern for the last 7 or 8 years.
Okay, I see signs of life lately for the chip makers, and that's helping some of the household names out there. Microsemi is a company maybe people aren't as familiar with. What do they do, and what do you like?
Well, I don't blame them for not being familiar with it. We weren't familiar with it until we found it. And that's the advantage of using screens and going bottom up. And I hate to talk about the chip makers in general because they all have very different businesses, and Microsemi's in a really niche business. They make super high performance chips. They're not used in common household everyday items. They're used in things like airplanes and missiles and communications equipment that runs the cell phone network. So super high performance, not a lot of volume, but great margins, great returns on capital. So it's a very profitable business. They keep finding new markets to sell their chips into, which is giving them good growth, not spectacular growth, certainly much better growth than Lincoln National. But this is a business that grows at a high single-digit rate, 7-8% a year. Bottom line earnings grow more like 10-15% a year, and it too is valued at a very modest 10 times earnings.
Okay, Goodyear tire. I heard you speak earlier. When I hear about tires, I think, what about competition from cheap tires overseas? And I heard you saying that this company has more protection than that, a sort of bigger moat than some investors might understand. How so?
Well, low-cost Asian tire imports killed Goodyear Tire 15 years ago and nearly put it out of business. But they're out of that business. They still make tires, but they make high-end tires. And that is a business where there isn't competition from the low-cost Asian manufacturers. In fact, it's a segment that the Asian manufacturers can't compete in. They don't have the technology, the way they run their factories. They're not able to compete in that business. And so in the first decade of the 2000s, they painfully got out of that low-end business. The business today is far better than it's ever been in the history of the company. They're making record profits, and they still have more room to go in improving their margins. Before the economic downturn, they were making about $1.60 a share. Today, they're making $4 a share. And although the company has proven it on the bottom line with the earnings, the market still seems skeptical. So you can buy Goodyear Tire at just 7.5 times this year's earnings.
And as you were saying earlier, no matter what happens with cars, whether people are driving them in the future or computers or dogs,
they're going to have tires.
Thanks, Andrew.
Thank you.
And thanks for watching.